Here's a startling revelation. The latest U.S. producer inflation data suggests that demand might be cooling faster than anyone expected. But here's where it gets controversial. While some see this as a sign of economic weakness, others argue it's a natural adjustment to ongoing trade tensions. Let's break it down. Summary. Producer Price Index (PPI) dipped 0.1% in August, defying expectations of a 0.3% rise. Goods prices inched up 0.1%, while service costs eased by 0.2%, painting a mixed picture of inflationary pressures. Year over year, producer prices rose 2.6%, down from July's 3.1%, hinting at broader economic shifts. In a surprising turn, U.S. producer prices fell in August, driven by shrinking margins in trade services and a modest uptick in goods costs. This suggests businesses might be absorbing some of the costs from import tariffs rather than passing them on to consumers. And this is the part most people miss. Despite these tariffs, inflation at the producer level remains subdued, which could signal weakening domestic demand amid a sluggish labor market. The Federal Reserve is widely expected to cut interest rates by a 0.25 percentage point at its upcoming meeting, resuming its easing cycle after a pause in January. That pause was due to uncertainty over the impact of President Donald Trump's sweeping import tariffs. But here's the kicker. Trump himself has seized on the mild inflation data to pressure Fed Chair Jerome Powell for a larger rate cut, calling him derisively too late on social media. Are retailers shouldering tariff costs? The Labor Department reported that the PPI for final demand fell 0.1% in August, following a revised 0.7% jump in July. Economists had predicted a 0.3% increase, a 0.2% drop in services prices, particularly a 1.7% decline in trade service margins, drove the overall decrease. This aligns with recent earnings reports, where companies admitted they've been absorbing tariff costs but warned of eventual price hikes. However, not all sectors are feeling the pinch equally. Here's where it gets nuanced. While trade services margins shrank, other areas like portfolio management fees plus 2.0%, airline fares plus 1.0%, and hotel room costs plus 0.9% saw increases. Goods prices also rose slightly, with food prices up 0.1%, though this was offset by falling costs for eggs and fresh fruits. Notably, beef and coffee prices surged due to tariffs, with wholesale beef up 6.0% and coffee jumping 6.9% year over year. The Fed's dilemma. While Trump pushes for aggressive rate cuts, economists caution against complacency. They argue that PPI data is too volatile to draw definitive conclusions, reflecting businesses' ongoing adjustments to tariffs rather than long-term trends. But here's the question. Is this softness in inflation a temporary blip or a sign of deeper economic stagnation? With consumer price data set to release soon, economists predict a 0.3% monthly increase in the Consumer Price Index, CPI, with core CPI inflation holding steady at 3.1% annually. If consumer inflation firms up, it could exacerbate concerns about stagflation, a toxic mix of slow growth and rising prices. Adding to the worry, recent labor market data revealed the economy likely created 911,000 fewer jobs than previously estimated, with job growth nearly stalling in August. The bigger picture. As the Fed prepares to cut rates, the debate rages on. Is this the right move to stimulate growth, or are we overlooking the risks of persistent inflation? Here's a thought-provoking question for you. Could the current economic softness be a self-fulfilling prophecy, driven by uncertainty over tariffs and monetary policy? Share your thoughts in the comments. Let's spark a discussion.